Warren Buffett's Berkshire Hathaway just released its 2025 shareholder letter, and it's making waves on Wall Street. A record $334 billion in cash reserves, a $23.5 billion bet on Japan, and a leadership transition as Buffett, at 94, prepares to hand over the reins to Greg Abel. Is Berkshire still the fortress it's known to be, or are there hidden risks ahead? Let's delve into the data, the drama, and what AI forecasts for the future of this $1.1 trillion conglomerate. Berkshire's core strategy remains: acquire robust businesses and hold them indefinitely. However, 2025 highlights two significant shifts. First, energy expansion. Berkshire Hathaway. Energy, now approximately 92% owned by Berkshire, continues to invest heavily in renewable energy, focusing on wind and solar projects. Second, international diversification. Its $23.5 billion investment in Japanese trading companies like Itochu and Mitsubishi now yields over $800 million annually in dividends. WSJ AI models predict that Greg Abel may target infrastructure projects in emerging markets or AI-driven insurance ventures for Berkshire's next major acquisition. Analyzing the numbers, operating earnings reached $47.4 billion, a 21% increase, bolstered by a rebound in GEICO's performance. Cash reserves have soared to $334 billion, providing Berkshire with substantial flexibility for future investments. Berkshire Hathaway maintains a conservative financial structure with a debt-to-equity ratio of 0.19, significantly lower than the S&P 500 average of 0.61. This conservative leverage indicates Berkshire's strong balance sheet and prudent financial management. However, it's noteworthy that 53% of Berkshire's subsidiaries experienced a decline in earnings. Can Abel revitalize underperforming units like Precision Castparts, which Buffett once referred to as a $10 billion mistake? Berkshire's current P/E ratio stands at 12.06, which is attractive compared to the S&P 500's 25. However, if you exclude unrealized gains and look only at operating earnings, the adjusted P/E ratio jumps to around 25, depending on the market cap and quarterly earnings basis used. This discrepancy has been highlighted by Warren Buffett himself in past letters to shareholders. He often advises ignoring quarterly GAAP swings caused by market fluctuations in their stock portfolio. Finance charts, AI-driven valuation models highlight several risks. Climate change poses a significant threat. A severe hurricane season could result in substantial insurance losses. Rising interest rates, while beneficial for certain investments, may adversely affect rate-sensitive holdings in Berkshire's portfolio. On the upside, if dividends from Japanese investments double and energy profits surge, Berkshire's stock could reach new heights by 2030. Conversely, a combination of catastrophic insurance losses and technological disruptions in key sectors could lead to a 20% downside. Berkshire's competitive advantage lies in its diversified portfolio. BNSF Railway transports 25% of U.S. freight, with little competition in sight. Berkshire Hathaway Energy supplies power to 10% of American homes. The company manages a $171 billion insurance float, providing a substantial investment pool. The pressing question is whether Greg Abel, with his background in utilities, can emulate Buffett's success in technology investments. AI forecasts suggest his first major move could be a $50 billion acquisition, potentially targeting companies like Chubb or emerging tech ventures. So, should you invest in Berkshire in 2025? Here's the AI-assisted analysis. Buy if you're seeking a stable investment with inflation-resistant earnings and steady growth. Hold if you're cautious about potential market volatility and awaiting clearer signals on Abel's strategic direction. Sell if you're pursuing high-growth opportunities in sectors like AI and technology. The $334 billion cash reserve positions Berkshire to capitalize on significant opportunities, potentially driving substantial shareholder value in the coming years. Even though the current stock price seems overvalued, I recommend considering an initial position at current stock price of $500 and being patient from there. If the price dips further, it's a great opportunity to dollar cost average. If it holds steady or moves higher over time, that's also a positive outcome. I'd love to hear your thoughts. Please share them in the comments below. And if you found this analysis helpful, don't forget to like and subscribe for more videos.